Has the fiscal cliff arrived? Is America in a silent depression? Is the debt crisis upon us? In today's video, we'll uncover the intricate world of interest rates, debt, and economic growth. We'll explore the persistent mortgage to 10-year treasury spread, its implications for the risk-free rate, dive into real yields and their nuanced relationship with inflation and growth, and dissect pivotal shifts in America's economic landscape, including a crucial turning point in the late 90s and early 2000s. Okay, so this first chart here is nominal growth. It's a baseline chart, so when it goes orange, that is negative nominal growth. Remember, nominal growth includes inflation, so it is real growth plus inflation or deflation. And then in red we have real growth. This should be real growth. And what we can see is that, generally speaking, the what I kind of wanted to point out, a number of people left comments on the prior video about Japan's lost decades of very stagnant growth and high unemployment and kind of poor economic conditions, and compared it to post GFC. And that's what I want to highlight here is that America historically, I was born in the 90s, and the early 90s, and America historically had real GDP growth above 3%. Right. We can see this going back all the way to the 70s. Yes, of course, there were recessions here. But in general, real growth was like here in 76, it was 6%. And then in 77, it was 5.5, right? 79, it was 6%. Here, it was consistently above 6% for about a year, right? But in general, is above 3%, above 3 or 3.5%. Strong growth. We can see nominal growth was also strong. Remember, nominal growth includes inflation, and so that is part of this white line. And we can see, in the 70s, the inflationary time period of the 70s, nominal growth was at one time above 16%, which has only been seen in the brief aftermath of the 2020 issues in 2021. But what I want to point out is post GFC, that's this big dip here where nominal growth fell to 6%, meaning the economy was shrinking 6% a year. Real growth fell to negative 3.7%. Following the GFC, real growth has been below 3%. It has been stagnant and below trend, right? The trend for real growth was much higher from the 70s all the way through the 90s. Real growth was above 3 or 3.5%. But post GFC, we have in America been in a bit of an economic malaise where real growth is actually not very strong. And, sure, we might have nominal growth here, like in 2018, nominal growth was 6%, but you can see the delta between the white line and the red line indicates that that was just inflation, right? The delta between the white and the red indicates it's basically just inflation. And you can see that delta here, very pronounced in the 70s when there was high inflation. You can see the difference between real growth and nominal growth was very high. But the point is that real growth was above 3 or 3.5%. Despite the inflation, there was still real growth. And what do we see recently? So now I'm going to throw on the 10-year treasury yield and the 30-year treasury yield. And this is a locked chart, meaning one scale that shows the percentage for all of the lines here on the chart. I'm going to remove real growth here, real GDP. What I want to point out is this nominal growth, which includes inflation, has been above the 10-year and the 30-year treasury yield for the vast majority of the time going back to the early 2000s. We see these brief spikes downward below the yield, nominal growth falling below the interest rate on our debt. And we will get into that in a couple of slides from now. But just here, what I want to point out is that nominal growth above treasury rates is what the government wants. There are real yield concerns, which we'll also get into shortly. But in general, you want nominal growth above the interest rate or the cost of your debt. And we have been able to accomplish that for the past 20, 25 years. Well, what do we see here? This is what I think is really important. So this data, the nominal growth, nominal GDP data only goes back to April of 2025, last month. And currently, the 30-year treasury is trading actually at 5%, and the 10-year treasury is at 4.5%. Well, we see that as of the most recent data, nominal growth is only 4.3. We are getting treasury rates crossing above higher than nominal growth. This is the exact opposite in a debt dynamics and an ability to service debt. This is the exact opposite of what the government wants. In fact, the 30-year treasury is now 70 basis points higher than the 10-year treasury. Excuse me, than nominal growth. The 10-year treasury is about 25 basis points higher than nominal growth. This is the exact opposite of what the government wants. This makes debt service more difficult and kind of by definition will increase the debt load, and the ability to service the debt will become harder. Now, it's important to point out that shorter rates are actually still below nominal growth. The 7 years at 4.31, so right at nominal growth, but the 5 year is at 4.1. And the 2 year is at four even, right? 4.0. So these shorter maturities, the interest rate, the cost for those bonds, lower still than nominal growth. This is good. And Besant, the Treasury Secretary, was very critical, along with many others, by the way, of the prior administration's decision to stimulate the economy and shift issuance towards the short end of the yield curve. This was termed by Rubini as there's a great paper called Activist Treasury Issuance. And I would highly recommend that. But basically, the theory here is, remember, a $100 bill is basically a treasury bond. It's a treasury bond with no interest and no maturity, instant maturity. Put another way, a treasury bond is a dollar with interest and with a maturity. They are very equivalent. Well, the shorter the maturity is, the more money like it is. Also, the less volatile it is. If you look at the performance of the 2 year bond versus the 30-year bond, the 2 year bond is down over the past 4 or 5 years by, I think, 10 or 15%, but the 30-year bond is down by like 40%, right? The long bonds have just gotten absolutely crushed. And the reason for this is convexity. And we've gone over this concept in prior videos. But what I really want to point out here is that, despite being so critical of this pro liquidity stimulatory decision to shift issuance towards the short end of the yield curve under the prior administration, the current Treasury Secretary basically has said he's going to continue doing that. So there are consequences to that. Two consequences I think are the most important. One, we established shorter maturities are more money like, right? So this is pro liquidity, this is inflationary, this is stimulatory, number one. Number two, you are basically kind of tying the hands of both the government and the Fed, right? Because now, if you're issuing all your debt at, say, 3 month, 6 month maturities, those are basically trading off of the federal funds rate. The 5, 10, 20, 30-year bonds, the longer bonds, they trade on other things, but the shorter ones trade basically just off of the federal funds rate. So by issuing so much debt at the short end, you are you don't have a buffer, right? If inflation spikes and the Fed has to hike rates, boom, within 3 or 6 months, right? You got to re-roll the debt, you got to refinance the debt and roll it over. Well, you don't really have much of a buffer because the Fed had to raise rates, so now you got to roll it at a higher rate. That's the idea behind trying to buffer issuance and spread it out and term it out with some longer maturities. And so there are consequences. Now, as we looked at with Japan, you can do this. You can issue very little short-term paper and issue, very very low amount of long-term bonds, but a lot of short-term paper, and kind of sort of get away with it until you can't, right? Until the Fed has to raise rates because inflation is spiking for whatever reason, and now you got to re-roll all your debt because it's maturing every 3 months, 6 months, 1 year. You don't really have a buffer. So those are two really critical pieces. Now, the 10 and 30 have crossed above nominal growth. That is not good. But again, most debt is not being issued at the long end, it's being issued at the short end. So it's important to watch this nominal growth number, and we will, in relationship to various treasury maturities, as well as continue to watch the quarterly refunding announcement, which is where the Treasury comes out and says, okay, we're going to issue 100 billion 2 year notes. We're going to issue 150 billion 5 year notes, right? They tell you how they're going to spread the debt issuance out. So why is all of this talk coming up? Why are there issues with the debt? Why are there issues with the bond market? Here is a chart of the federal deficit as a share of GDP. Remember, the deficit is the difference between what the government collects in tax revenue versus what it spends, and that's seen in white. As this white line is going down, that increase that indicates an increase, right? A higher deficit as a share of GDP. And this chart goes back all the way to the 50s. And we can see that, the earliest data we have in 1947, the deficit was about 7% of GDP. And what I've always pointed out is that, it is normal for the deficit as a share of GDP to increase during a recession with high unemployment, right? You got to pay unemployment benefits, jobs programs, stimulatory programs by the government to try stimulate the economy, right? That is the idea in recessions or in the 40s, World War. But what do we see here? We see a current deficit. Now, this isn't current. The actual deficit is running more at 7% of GDP. When you look back, how many times can you see where this white line was down here? Outside of great financial crisis, which almost brought down the global economy, outside of that, and outside of what happened in 2020, it's never been seen before. And in fact, when you throw the unemployment rate here in red, inverted, meaning as this line goes up, unemployment is actually going down. So you could think of this red line as employment, or the strength of the labor market. And we can see it's actually at historic heights. Now, there are issues, and this video is not the time or place to get into them. There are issues with the labor market that we could address in another video. But generally speaking, right, the labor market is extremely strong, but yet we have this huge deficit. And now it made sense to run a very large deficit in 2020. There was something that almost brought down the global economy, right? It was very tumultuous. It made sense to run a deficit. The problem is that over the past 5 years, no one really made an effort to bring it back to normal, which is, 2 or 3% of GDP. No, they kept it at, 5, 6% of GDP. This is the problem. What this deficit increases as this white line goes down, and the deficit is getting larger, what that means is more bond supply. More bonds must be issued. Remember, the yield is inverse to the value of the bond. If a huge amount of supply of something is coming online and demand is constant, the value of that thing will go down. And in the case of a bond, what that means, as the value goes down, the yield goes up. So here is the 10-year real yield. This is the 10-year treasury minus CPI. And then in red, we have the spread that George Robertson, very smart guy on X, kind of concept he came up with to try to better approximate the real risk-free rate. And so that takes the 30-year mortgage minus the 10-year treasury. Remember, mortgages are basically government guaranteed. The government backstops and guarantees the mortgage market. And so this gives kind of an indication of the spread, the difference between the mortgage rate and the 10-year treasury rate. We have covered that due to the reserve currency status of the US, of the dollar, the US must run ever larger trade deficits and current account deficits. What this means is that an equal amount of that current account deficit must be recycled into financial assets in the US, the primary one being the US Treasury. So as we have run ever larger trade deficits, right, over the past few decades, what that means is it is guaranteed buyers of US financial assets. This is just how balance of payments, capital account surplus, this is just how it works. And so by guaranteeing buyers of US Treasuries, that means yields will fall. Well, what we see in red, and they have, clearly. We also have engaged in quantitative easing, right, where the Federal Reserve is printing money to buy bonds, which is good for the value of bonds and bad for rates, right? Rates come down as the value of the bonds go up because you have this huge buyer in the Federal Reserve and you have another huge buyer in the rest of the world recycling our current account deficit into our capital account. Well, in red, we see kind of the opposite, right? Real rates have been falling, generally speaking. And I drew this trend line here in white to try to approximate, to show that we are seeing real yields breaking out to the upside. Remember, as this number goes positive, that is indicating it is harder for the government to finance the debt. right, and refinance the debt. And what we see in red is that we've seen kind of the opposite trend, which is this line, you could call it range bound, basically going back to the 80s, but in general, it has been setting higher lows. And in fact, it has come down, but it has set this really high floor at about 2.3%, meaning mortgage rates are 2.3% higher than US Treasury, 10-year Treasury rates. And look, going back, outside of brief kind of recessionary contractionary issues, idiosyncratic times, going back, that spread has never really been this high, and it is staying kind of stuck, indicating that the real risk-free rate is actually higher than people are realizing. um, and again, the real yield is rising here in white and basically breaking out to the upside. I will draw a yellow line here at 0%. So you can see that anything above this green line is a real yield, positive real yield. Anything below is a negative real yield. And we can see that this is, as this real yield has been trending down, it has allowed the government to issue more and more debt without it being as much of an issue. So here's another concept that I want along those lines I want to illustrate. Here we have the 10-year nominal yield minus nominal GDP. And then in blue, we have debt to GDP. What I want to show here is that I've talked about this period of time a lot, the 60s into the early 80s. You can see that the 10-year treasury yield was below nominal GDP. And what do we see with debt to GDP? Well, it got better. It decreased. And then what happened in the recession of the 80s and everything that followed within the 80s, we saw real yields, right? The 10-year treasury yield became higher than nominal GDP above the yellow line, and we saw debt to GDP increase. And then real yields fell, right? This is another way to kind of think of real yields. Fell below the yellow line, fell below 0%, and debt to GDP decreased, right? And kind of even counting this little bump here, generally speaking, decreased for this period of time as the 10-year treasury yield was below nominal GDP. Well, what do we see in the great financial crisis? The real yield spikes higher to 9.3%, 9.4%. And we see debt to GDP similarly increase, right? As the real yield turned negative, again, below nominal GDP, debt to GDP remained relatively constant. I mean, it only really increased here from 99% to about 105% during the kind of mid 2010s. And we had this kind of negative real yield where the 10-year treasury was not compensating you as much as nominal GDP. And remember, it's supposed to approximate nominal GDP. Well, then we saw another spike higher, right, in this real yield. And sure enough, debt to GDP increased and spiked higher. Since then, since about 2021, early to mid 2021, rates have been negative, right? The 10-year treasury has not yielded as much as nominal GDP, or nominal GDP has been higher than the 10-year treasury rate. And we see debt to GDP has kind of decreased, stayed, flat. But what do we see recently? We see it breaking above 0%. So the 10-year treasury, going back to the same concept we outlined here, with this kind of way to think about it, and that breaking out to the upside, we also have the 10-year treasury minus nominal GDP starting to turn positive. What this indicates is the ability for the government to service the debt becomes harder, right? Inflating the debt away, financial repression, all these concepts, it is harder for the government when this red line goes above 0%, when nominal growth becomes lower than the 10-year treasury yield. Put another way, when the 10-year treasury yield is above nominal growth, it generally speaking results in an increase in the debt load and the burden of that debt. So here's another way to kind of look at it. It's the same exact data, except I displayed it slightly different. So here in red, there again, it's a locked chart, locked percent. So the same scale for both nominal growth in white and the 10-year treasury yield in red. And we can see it's the same exact data, just displayed slightly different. We can see that nominal growth was above the 10-year treasury yield from the 50s all the way through to kind of the late 70s. And sure enough, debt to GDP decreased, right? The red line started to go up, trend above the nominal growth, right? So the interest rate on the debt started to trend above nominal growth, and we can see debt to GDP increased. Well, there was kind of this turning point, and this gets into the silent depression. So just bear with me here. Um, there was kind of this turning point in the late '90s, right, where the 10-year Treasury yield had been kind of above the nominal growth, right? But then things started to change and nominal growth started to run hotter than the 10-year treasury yield. Put another way, you could argue the government was starting to try to kind of inflate the debt away by running the economy hotter, higher growth rate than the interest rate on the debt. And this is fine. Again, remember, this is okay for the government. If you can run nominal growth hotter than the cost of your debt, theoretically, you're all right. Well, what do we see? Again, there is a cross here. You know, we covered this in the first or second chart. This is starting to cross, right? The cost of our debt is starting to rise above nominal growth, especially at the longer maturities. So here's yet another kind of way to visualize some of this data. Here's the 10-year treasury yield in white, and then nominal GDP, which is these first two metrics, plus what's called term premium, which is basically a premium that is being demanded to buy longer duration bonds. In this case, the 10-year treasury bond. And currently that's about 50 basis points by the Fed data that I have access to. And so what we can see is that, this real GDP plus inflation, which gives you nominal growth, plus the term premium is actually above 10-year treasury yield, indicating that the 10-year treasury yield is somewhat suppressed. And we went into the structural reasons for that with the current account deficit, capital account surplus, QE, right? Fed printing money to buy bonds, which pushes yields down. And so I think it's interesting though that the 10-year Treasury yield is starting to break out above this. Currently, this red line is 4.8, and the 10-year Treasury is at 4.5. So they are coming pretty closely into balance of theoretically what the 10-year Treasury yield should actually be. This indicates the 10-year Treasury yield should actually be about 4.8%. So again, we highlighted in this chart, we highlighted this period of time in the '90s, in the late '90s, when rates started to fall below nominal growth. And so here, what I want to show, I want to illustrate that, right? So this is the same chart we were just looking at. This period of time in the late '90s, when nominal growth started to rise above the cost of the debt, this was kind of a turning point, right? And we can see nominal growth, generally speaking, has been above the cost of the debt. Well, this corresponds to a number of things that I have noticed. And so I will show those now. Here we're going to look at personal income divided by M2 money supply. This gives an indication of the real purchasing power of personal income, of the average American's wages. Remember, inflation is a monetary phenomenon. M2 money supply directly measures the money supply. As they print money and the purchasing power of every dollar out in circulation goes down, this is a way to adjust for that. So you take personal income and divide it by M2, and sure enough, what happened in the late '90s, early 2000s, personal income, the real purchasing power of wages, peaked. And it should also be noted the China shock, China's admission into the World Trade Organization, happened in 2001, which is the end of the right hand edge of this yellow box. Here's another way to measure the real purchasing power of wages. This is the average hourly wage divided by gold. Remember, gold, it responds, right? As money is printed, there's only so much gold out in circulation. So as more money is printed, the value of each unit of gold goes up, right? So gold is a really good way to measure kind of real inflation and the real purchasing power of a currency. And we can see the same thing. It peaked. The real purchasing power of the average hourly wage peaked in the late '90s. Should be noted that from the mid to late '70s all the way through to this kind of late '90s period, the average American was benefiting, right? The purchasing power of their dollars was going up. the purchasing power of their wages was going up. But since kind of the late 90s, early 2000s, it has been declining pretty relentlessly, in my opinion. And so here is yet another thing that peaked in the late 90s. This is the money velocity. So this shows the degree to which money is changing hands in the real economy. And sure enough, it tracks almost perfectly with personal income, real personal income. They're essentially the same line. And we can see that that also peaked in the kind of late 90s. This is an indication of kind of real growth, right? Like how much money is actually changing hands in the kind of real economy? How often are people spending and transacting? And right, hopefully that makes sense. And so here in red, we have another thing that peaked in the late 90s. This is the S&P 500 divided by gold. And again, this shows the real purchasing power returns of the S&P 500. As this red line goes up, the value of the S&P 500 is increasing in real terms. As it goes down, during this period of decline, your S&P 500 stocks, you might have a green number on your screen, but if it's all caused by inflation, right, which is measured by gold and adjusted by gold, if it's all caused by inflation, sure, the number in your brokerage might be green, but you are actually losing money on a purchasing power basis. And I've covered and mentioned this period of time that I believe we're in, this kind of populist era of the mid 60s into the early 80s. Chem Carson also talks about this a lot. Huge credit to him for thinking and great minds think alike. Um, but yeah, I think that this is similar to what we're kind of starting to experience now. And if you zoom forward, right, what happened to the real purchasing power of S&P 500? It went down severely. I think from this peak down to here in the mid 70s was a decline of 60%. The real purchasing power returns of the S&P 500. And what do we see? It peaked in the late 90s, same exact period of time that all these other metrics peaked. And also, what do we see? We see, I think it's important to point out here, if you had invested money in the S&P 500 10 years ago, a decade ago, on a real purchasing power, in real purchasing power terms, you are flat on your investment. If you invested here in 2018 or 2021 or 2022, 2023, you're down, right? This is a super important concept for people to understand. The real purchasing power terms, performance of an asset or an instrument versus just the nominal number, right? If the dollar is being debased and printed, and there are more dollars chasing the same amount of goods, the price will go up. But it's an optical illusion because the real return could be negative, as we see here, right? And so again, there's this final metric that I think is important here, which is M2 money supply divided by GDP. And what this shows is, remember that when the numerator is growing faster than the denominator, this line will go up. And sure enough, that same exact period of time in the late 90s, early 2000s, China shock occurred here in 2001. The same exact period of time, we see the money supply has been increasing faster than GDP. Remember, money printing, government spending, deficit spending is counted in GDP. So the government theoretically could print $5 trillion tomorrow, spend it out into the economy, and that'll be GDP. That'll be positive effect on GDP. It's kind of insane, but this is how it is. About 25% of GDP is based just on government spending, just debt-fueled deficit spending. It's insane, but this is how it is. And what we can see is they have been trying, right? This is the same period of time where nominal growth started to run hotter than the 10-year treasury yield, right? And we have clearly a number of metrics that we just went over. Money velocity, real purchasing power of wages measured two different ways. The real purchasing power return of the S&P 500, a number of things all peaked in this late 90s, early 2000s. And they have been trying to print their way to prosperity, and it is not working. The more money that they print, the less GDP that they're getting, right? The other way to visualize this, here's GDP divided by M2. And we can see that, there was strong growth in the 80s and 90s, right? GDP was outpacing money supply. This is real growth. This is good. But then it peaked. in the late 90s, early 2000s, and has been declining relentlessly ever since. And just to finish up here, I want to show the real GDP as measured properly, in my opinion, which is by dividing by M2, the real GDP. So from April 1995 to April 2025, in the past 30 years, uh, GDP has lagged by 36%. We have seen a negative 36% return of GDP. Put another way, the M2 money supply has increased faster than GDP by 36% over the past 30 years. From April '07, right before the great financial crisis, until April 2025, that is negative 30%. What this means is that real GDP, the real economy in real purchasing power terms, has contracted or underperformed the increase in the money supply by 30% since the lead up to the GFC. And then here I listed kind of 2 year periods, right? So from December '07 to December '09, 11%. From '09 to 11, negative 6%. Same thing for 11 to 13. From 13 to 15, 5%. From 15 to 17, 3%. I think all of these things are starting to be reflected and sniffed out by the bond market. And so I think that, there's a lot to cover here. And I can do videos on the silent depression. I've done a lot of work on this kind of trend rate versus what we've actually seen. If people are interested, leave a comment. A lot of that work is on my X account under the highlights tab. But the point here is that, something changed in the late 90s. And we see that reflected whether it's with, nominal GDP starting to diverge and run hotter, right? The government trying to kind of run the economy hotter than the interest rate on their debt, or the number of metrics that we went over here. Real purchasing power of wages as measured by these two lines, the real performance of the S&P 500 in real purchasing power terms, everything peaked. The money velocity, everything peaked in the late 90s. And ever since, they have been in trouble, in my opinion. The real economy has been in trouble, in my opinion. This is reflected if you talk to especially younger people. They will tell you this, that, really what we have gotten since early 2000, but especially since the GFC, is this hyper financialization, where financial assets are just grossly outperforming real wages. And so here, just to finish up, I'll show this U.S. wages. This is the average hourly wage divided by the S&P 500. And what we can see, what this means is this purple line is going down. Here, I'll put it a different way. I'll invert it because I think it's easier to conceptualize. Um, so what this indicates is the number of hours that are needed, right? The average American making the average hourly wage. How many hours of work must they work to buy one share of the S&P 500? And what we can see is that financial assets post GFC here, financial assets have just grossly outperformed average hourly wage. So if you work for a living, financial assets and asset inflation has just run away from you. Whether it's housing, right? We know that the affordability of housing has had a similar phenomenon where it's just utterly unaffordable nowadays for young people to buy a house. The same is true for financial assets like the S&P 500. They have greatly outpaced the wages. And this is reflected in a number of metrics. Again, if people are interested, I can kind of dive into some of these concepts in another video. But this is what we've gotten post GFC. We went through all the other metrics that showed kind of the opposite trend, right? What is underperforming? The real economy, real wages, money velocity, the real return of the S&P 500. All these other metrics that show that like something broke, and we are not okay. It is not okay that the purchasing power of the average American's wages has looked like this for 20 years. So arguably, the video I did on Japan yesterday, arguably, America has been in its own version of the lost decades of a silent depression. And I think that this is really important to talk about. Hopefully, that was educational. Hopefully, it was helpful. And hopefully, it was not too depressing. There are solutions to this. But I think it's good to be honest with our reality. So, anyways, hope that was helpful. Hope it was educational. If it was interesting, that's great. Leave a comment if you want to see videos on any of the concepts we touched on, and I'll see you guys later.